Hey folks, we have a very important video to discuss today, and that is on Chipotle. So, while the market obsesses over tech volatility and consumer spending fears, one of the strongest compounding machines in the restaurant industry is sitting at prices that rarely materialize, and that is Chipotle Mexican Grill. And they have been beaten down by short term macro anxiety, creating a potential value arbitrage opportunity. This isn't a struggling business trying to find its footing, this is a premium brand with pricing power, industry leading digital infrastructure, and a relentless unit expansion trading at a discount that doesn't reflect its fundamental strength. So, the reason we're talking about Chipotle today is that they have a business model that separates them from the pack. Chipotle operates in the restaurant sector, but it's fundamentally different from most companies in ways that create structural advantages. With over 3,500 locations focused on premium customizable burritos, bowls, and salads, the company has built a brand that commands pricing power in an industry where most players compete on price. So, what makes Chipotle different? Well, the first is there's zero franchise exposure. Chipotle owns and operates every location, meaning tighter quality control, higher margins, and no messy franchise disputes that plague competitors. None of them are individually owned. They're all owned by Chipotle. And folks, we're going to dive a little bit into this. It's their business model, which affects the stock, but it's also an interesting business play. So lots of chains like McDonald's, Subway, etc. do something called franchising, where each location is owned by some individual, and that individual pays the cost of building the restaurant, pays the rent, basically runs totally independently. The corporate office of McDonald's, for example, gets royalties and fees. That's it. Subway is the ultimate example of this. So literally anyone could open a Subway. Companies do this because it's ultra fast expansion. So it's a way to expand the brand super quickly, lower financial risk. So corporations don't have to pay for construction, equipment, day-to-day operations, or anything like that. They just get the royalties from the location. McDonald's has a real estate strategy. So they often own the land or the building, but the individuals or franchisees who own the individual McDonald's location have to pay not only royalties to McDonald's but also rent to McDonald's. So that gives McDonald's stable, high margin real estate income in addition to all their profits. So Chipotle does the total opposite. It's super tightly controlled operations, tightly controlled menu, food prep, process, ingredient standards. Corporate owns everything in Chipotle. So why do they do this? Well, part of it is the customer experience. Every Chipotle kind of looks the same. The food's the same. It's very consistent. Same menu, same prices, same digital pickup system. And the reason they do this is because it's less complex to operate. They want it to grow as efficiently and consistently as possible. That's the brand's play. And Chipotle wanted to just kind of control everything. And so the biggest thing this does for Chipotle is higher margins. The company also has digital dominance, so ranks first across most major delivery apps and has built one of the largest digital loyalty ecosystems in the entire restaurant industry. There's premium positioning. So unlike value-focused chains, Chipotle maintains pricing power even during economic uncertainty because customers view it as affordable premium dining. And as we mentioned earlier, the corporate office is able to just change all the prices like that. So that really helps. So why the big sell-off, and why does that sell-off miss the fundamental story? So the recent pullback in Chipotle shares stems from broader fears about consumer spending and macroeconomic uncertainty. Investors are worried that consumers will pull back on discretionary restaurant spending, and this concern has created indiscriminate selling across the restaurant sector. But here's what the market is missing. Chipotle continues delivering exceptional operational performance despite these fears. The company is posting double-digit same-store sales growth, expanding margins, and maintaining aggressive unit expansion. They're opening 150 to 200 new stores per year with plans to accelerate. So these aren't the metrics of a business experiencing consumer pullback. These are the numbers of a company gaining market share, improving efficiency, and executing a proven growth strategy regardless of near-term economic noise. So when a company's stock price disconnects this significantly from its actual business performance, this is when opportunities emerge. Anyway, folks, that's it for today's video. Don't forget to like and subscribe, hit that beautiful like button, and we'll see you in the next video.